Hi YouTube. Today we're going to be talking about universal life insurance. Now, if you've watched my past videos, which, there will be a playlist towards the end of this, you'll know about term policies and how those are good if you need options to buy in or get out of those policies. And you know that whole life is good if this is going to be a long-term policy, if you want the coverage to stay the same, if you want the fixed prices, this is kind of what you want to look at. But there's one other type. Now, I do want to give you a warning. This is the one type of policy. Let me adjust my camera a little bit. This is the one type of policy that Dave Ramsey hates. He's not a big fan of whole life, but universal life, he absolutely hates. So I do want to give y'all that preface, and we're going to talk towards the end about why. So if you're kind of wondering what's all involved, so there's the basic coverage, then there's the cash value. Sorry, this isn't written great. Then there's the banking part, which we'll talk about. And then lastly is a little bit of a warning for me, having sold a few of these policies, having been able to talk to other financial professionals who have, and just my experience as a former sales agent. So the first thing is the coverage. So like the rest of the plans, when you sign up, you get X dollars. It's, this policy that you have right now is going to be $100,000. Okay, cool. That's fine. And it's going to be X dollars right now. Now, the next part is it has a little bit of the whole life, and that's going to be the cash value. And basically what this is it's money that you overpay, because that's technically what it is an overpayment to the insurance company that adds a cash value, meaning a separate amount that you can theoretically pull from. And then at that point, with the cash value, now there's a warning that I'm going to give towards the end about the cash value and kind of what to expect, because there are some pitfalls that I want y'all to know before y'all buy. So with the cash value on universal life, it can be invested in the stock market. There's just lots of different options. It's mostly the stock market. There are some like treasury ones, where you can invest in the treasury. They have some inflation value ones. These are just different. Now, you will hear about quote unquote infinite banking, or creating a family bank or family trust. The other one that I've heard is there's a certain type of universal life that Walmart used and got in trouble. We are not going to go into that lawsuit. That is not a topic that we're going to discuss. I will discuss how the family and infinite banking work toward the end of the video. But that's what the cash value is. Now, I didn't realize it would come so soon, but the banking part. So with banking, it's advertised that this account can be used as a bank. Well, okay, cool. So I pay X dollars, and it starts building cash value. 5 years, I want to go buy a car. Cool. Except for not. And I'll get to that in a minute. As well as, okay, if I die with that out, how does that affect the actual policy? And I have to say, it's kind of sad. So with the with the with a whole life policy and universal life, if they have cash values, it's going to be one or the other. So I do want to just let y'all know that. But honestly, a good way of thinking about the universal life investment portion is, I want you to imagine paying your broker your fees. Imagine it's like a 401k. Over the lifetime of the policy, you're going to pay a ton in fees. That's just the way it works. Now, universal life is very similar. You're going to pay a ton in fees, except for it's all going to be at the beginning. So the first 3 years that you have the policy, nothing goes into that account. I was shocked when I learned this, because it's like, hey, you're putting money aside. This is a good investment. And then you find out, oh, where did it go? Well, it went to the broker. So I did want to let y'all know that. It does go somewhere, and it does have value, but again, it's not going towards your account yet. So at the 3 year and 1 month date, you are going to, let's say you're putting in an extra 100 for that account. You're still putting in that money, but maybe only 95% of it gets there. So there's still a small cut that goes to the insurance company. Now, some may waive this, some may have had it in the 3 years. Each insurance company is different. And although it may not be discussed, a question to ask when you're getting one of these policies is, when does the cash value start accruing? Actually building up so you can have something? Or are there any fees once it starts? Because some do, some don't. It all depends on the insurance company. Then the reason that it's called infinite banking and universal banking is because, like a bank, you can borrow. So this is going to be a lot like a 401k loan, except for there usually aren't management fees. Again, this varies by policy, but I just took a 401k loan, so that's how I know. But you're going to pay, with a 401k, you have to pay X dollars. In fees, you're going to pay X% in interest, and that's all predetermined by your employer. Now, with life insurance, with universal life, that's set by your insurance company. Usually it will be a little bit less than what you're paying on the actual, or what you would be receiving on the indexes and what your plan is set to pay you. Now again, there will be probably a small portion that does go to the insurance company. They have to make their money somehow, but it's called infinite banking because you can repay yourself, and the theory is you can take the money out, then put it back in, take the money out, and just cycle this, which is perfectly fine. And honestly, yeah, I have to agree. If you've had a universal life policy and you can buy a house, yeah, that might be better than using a bank. But one thing to consider is, that these ways aren't going to get you the best return. Now, I'm going to start moving a little bit away from the banking, because I have gotten off topic a few times on this category. And I want to start giving out some warnings. So first, 3 years, the first 3 years goes to your broker, goes to your agent. Now, that's not necessarily bad, but I do want y'all to know. For infinite banking, yeah, it works. You can borrow from it, you can repay it, And I think that's perfectly fair. But one thing that you need to know is that when you die, or when your spouse dies, you don't get both cash value and the policy. You get one or the other. And to make things worse and more like a 401k loan, if you die and you have a $100,000 policy, but you have $50,000 in outstanding loan, your family will only get the $50,000 that's remaining in the account. So they don't get the full amount. Now, again, like I said, this is an either or situation, and a lot of times they'll try and do what's best for you. You know, whether it's, you know, just giving you the cash value or the universal, the coverage. But it's definitely a rough topic. I don't want to, you know, make it sound great. And again, I'm not a sales agent anymore. Please contact one. But this is why Dave Ramsey doesn't like it, because it robs your family at the time when they can't be dealing with this, when they are very emotional, when they've just lost a loved one, and they find out that they may not have money. I have seen a case where someone had used, you know, 100% of their cash value, but it was also 100% of their coverage, and their family didn't receive anything. I'm not a fan of these policies, honestly. This is just my opinion, but you know, when a family is hurting, they don't need to worry about, oh, well, how much was left on this. That's what banks do. And I'm not bashing banks, but life insurance companies are supposed to offer hope. And offering hope when you're alive is one thing. And I definitely think that the sales pitch for infinite banking or family banks or multi-generational banks, yeah, sure, that works. I get that. Like, that's the only way that those work, is if you do them forever. But when you die, you want your loved ones to know what they're getting. And I don't think that it's disclosed enough on how these policies work. And lastly, this is just my story. And I know that I've been pausing, and I'm sorry that this is probably a slow video. When I was selling these policies, I didn't sell these policies for very long. I sold a total of 2, and I'm not really proud of it now. I asked another sales agent, I said, hey, why don't I do this? Like if we're making this good of products, why not? And the agent said, no. Even with your commissions that you would receive, he said there is no way that you could justify the cost of the 3 years if you put the money in the market for 3 years. You're most definitely going to have more money. And he said you can still invest in a regular term policy. Guys, this is what hurts me. It's not a fact of oh, I don't like insurance companies, or oh, I don't like certain agents. The fact that we, me included, would sell products, and I don't sell products anymore, so please contact an insurance agent. But the fact that you would sell a policy that isn't going to return anything unless the person dies in 3 years, that hurts. And the fact that in all cases, because I asked about this thoroughly, it was a 2 hour talk, just pure insurance lingo, trying to get through this, seeing tons and tons of different rates. I was trying to make it work, and we couldn't. There was no way that we could figure out how to make it work, and I don't want anybody to have to go through this, because it's a lot. And there's one more thing. So if you decide that you want to cancel your policy and get your cash value out, you're looking at about 60%, 60 to 75% of a loss. Yeah, on paper you can borrow from it, but in actuality you're looking at 75% loss, 60% loss. That's worse than taking money out of a 401k early, because on that, at most, you're paying 40%. I've seen policies that go up to 90% that you just lose. So that means that $1 million is only 100,000. And if you're hurting for money and you need it that bad, losing 90% of your money just is despicable. All right, sorry to drag this on. I want to thank y'all for watching this far. If y'all have any questions, comments, concerns, if I need to touch on this anymore, if I need to bring any more advice on this, let me know. All right, guys, thank y'all so much for watching, and I will see y'all next week.